If you're trying to become more vibrant, you're going to need a bigger lecture theatre. I'm very impressed. This is a fabulous crowd, so thanks very much for coming along. I'll try to make it entertaining and worth your while. This is the guy who I'm most associated with, Minsky. If I put up his face and mentioned his name 10 years ago, there would have been probably maybe 2 or 3 people in the room who'd heard of him. Who's heard of him now? Okay. Not quite the total majority, but pretty damn good. What I've done is try to take his ideas and put them into a mathematical framework, because to me, I know that a lot of critics of economics are anti-mathematics. I actually describe what's done by neoclassical economics, pardon me, or anybody in the room practices it, as mathematics. It isn't really mathematics. It doesn't actually do what we should be doing in mathematical modelling. And rather than being a critic like Tony Lawson, who's a good friend at Cambridge, who says we should eschew mathematics, I think we've got to get the mathematics right. So I'll be talking, that's pretty much the orientational take in this talk. Now, if you take a look at how we describe capitalism, probably the ultra-orthodox perspective on the nature of capitalism was given by Edward Prescott, who's one of the developers of real business cycle theory, which is the foundation of the modern-day DSGE modelling of the economy. For those who don't do economics, it stands for Dynamic, Stochastic, General Equilibrium. And in my opinion, it's neither dynamic nor general. It's stochastic equilibrium models. But nonetheless, writing about the Great Depression back in 1999, and that links through to the paper, of course, he made this little statement, which these days looks quite intriguing when you look at it back for the benefit of hindsight on the other side of the global financial crisis. He said, the Marxian view is that capitalistic economies are inherently unstable, and excessive accumulation of capital leads to increasingly severe economic crises. You should stop there, don't you think? But looking back at history, that's not a bad little summary. But he keeps on going and says growth theory, which proved to be empirically successful, said this is not true. Capitalist economy is stable, and absent any changes in technology or the rules of the game, the economy converges to a constant growth path over the standard of living doubling every 40 years. Now, that's a pretty orthodox perspective on the nature of capitalism, and it looks rather jaundiced after the financial crisis than before. Before the financial crisis is going back to 1969, and I'll show you why I choose that particular paper from Minsky at the time. Imagine now 1969 is boom time capitalism. And when I was a student, that was when I was finishing high school, when I began universities, Australia had a particularly low unemployment rate, but the unemployment rate in Australia was below 2%. Okay? It changed to about 4 to 5% in 1973-74, which is when I was starting to graduate. But to talk about capitalism being unstable and heading to crises at that time really does put Minsky out as a maverick. He talked about what he called the Chicago view, that there was a form of a financial system which would support capitalism and make serious disturbances impossible. He said my alternative, which he called unreconstructed Keynesian, was that capitalism, again, rather the Marxian statement beforehand, is inherently flawed, being prone to booms, crises and depressions. He then says this instability is, in my view, due to characteristics that the system must possess if it's going to support full-blown capitalism. In other words, it's not the sort of thing you can reform out of existence. Now, Minsky knew when he made this statement that it was an extreme statement. He led into this particular proposition by saying that I know this is extreme, because often people think capitalism's problems are due to things we can actually reform away. But he saw it as being due to the tendency of capitalism to both generate signals that gave you a desire to invest at an accelerating rate, and then providing finance that enabled that accelerating investment to occur. So you have two, what you can really see as ideological positions. So how can you actually bring them together and adjudicate between them? My starting point effectively is to start from a set of identities, and things you simply cannot challenge. They're definitionally true. So the employment rate, and I'm working now not with unemployment as it's defined, which I get all this messes with participation rates, but just with the number of people with a job divided by the population. That is the definition. Okay? And then you could expand employment out further and say that can be defined as output divided by labour productivity. And again, that's a definitional statement. You're actually defining labour productivity that way rather than the other elements of it. But that's definitionally accurate. Do the same thing with wages share of output. So the wages share of output is the wage bill divided by GDP. And this is the one that I'd throw in that comes from Minsky's work, which puts him outside the mainstream immediately, and even thinking this has any significance, but I'm going to show that it does. The ratio of private debt to GDP is private debt divided by GDP. And it's definitionally true. Don't bother arguing with those. Often what happens to economists, they will have different perspectives, different modelling perspectives. This, I think, gives us a starting point which is very hard to contest. All you can contest about this is whether any of these are relevant to the economy. And as it happens, neoclassical economics disputes the third. And this is quoting Ben Bernanke on this back in his essays in the Great Depression, which he wrote back and collected together in 2000. He said that Fisher's idea, talking about Irving Fisher's notion of debt deflation as an explanation for the Great Depression, was less influential with academics than it was with President Roosevelt, because of the counter-argument that debt deflation represented no more than a redistribution from one group, debtors, to another group, creditors. Now just take a look at that sentence for a moment. Anybody see a certain problem there, even on its own grounds? When somebody goes bankrupt, they don't pay their debts back. Not all of them. Okay, there's a loss going on that he's actually ignoring in that statement. But let's keep on. He then said, absent implausibly large differences in marginal spending propensities, pure redistributions, which is what he sees private debt as, and it's common to the neoclassical approach, should have no significant macroeconomic impacts. So he rules that out, says you don't need to look at it. But I'm going to question that. Say, is it really valid to leave that particular ratio out of economics?
Sorry,
yeah.
Those quotations are all Prescott.
Pardon?
Those quotations,
yeah.
They're all Prescott, aren't they?
No, the first ones are Prescott. Those were from Ben Bernanke.
Oh, right.
Yeah, I had it on the slide. So, and I linked through to where the quotes come from as well. So Minsky, on the other hand, asserts that there's a central role for private debt in economics. He starts by saying the natural starting point for analysing the relation between debt and income. And I might add, by the way, this is something which a lot of post-Keynesian economists don't agree with either. So I'm not saying that this is a clash of schools of thought here. Minsky actually is outside the post-Keynesians here by emphasising the role of private debt, and so am I, by trying to bring it in analytically. So we'll talk about that as I go through my presentation. But he says there is a role between debt and income. And so you've got to take an economy with a cyclical past, etc., etc. So what I'm going to do is take those three equations and turn them into a dynamic statement, simply taking, differentiating them with respect to time. And what you get is a set of chain rule outputs which you can actually summarise verbally. So the employment rate will rise if economic growth exceeds growth in labour productivity and population growth. And the wages share of output will rise if wage demands exceed growth in labour productivity. And the third one, which is fairly obvious, the private debt ratio will rise if private debt grows faster than GDP. Okay? Now those again are still definitionally true. There's nothing about that makes it into a model, but I've got to put them in equation. How many people are equation phobic in the room? Anybody? Nobody. Okay. I don't have to worry about that. Certain phobias about seeing equations turn up. This is just putting exactly those same verbal statements in equation terms. So there's the employment rate. There's the rate of economic growth. That is the symbol I use for growth in labour productivity, and that's what I use for growth in population. There's wages share of output. That's wage demands, whatever they might be determined by. I'm not even including any causal arguments, just that it's still definitional. There's the private debt ratio, and that's the rate of growth of private debt. Now, to turn that into a model, what you have to do is to provide some behavioural components to it. And what I do in a very simple way is put this behavioural and causal links between different variables that are part of those set of equations. And what I do is take the simplest possible statement of it. I know the world's more complex, but I want to start from a very simple foundation and see what we get out of that simple foundation. So I have output being a linear function of the level of capital. Investment being a linear function of the rate of profit, plus also I've got depreciation inside there, so I've got gross investment as a function of the rate of profit and net investment net of depreciation. Employment a linear function of output, and wage change a linear function of the employment rate. If you read Phillips's original papers, you'll see he argued for a nonlinear relationship, and I do emphasise you should read the originals, but this is just doing it very, very simply. And then change in debt being simply investment minus profit. So I've got no Ponzi. All I'm saying here is that investment is used simply to finance, debt is used simply to finance investment when desired investment exceeds retained earnings. So that as a set of equations then looks like this, which is slightly scarier, but not too bad, I hope. But looking at those, I've got three variables inside there and a number of parameters. The variables are in red. And when you look at them, there are some non-linearities there, things interacting with other things. Any fans of the Big Bang Theory series here? Okay, all right. There's the employment rate in the first equation multiplied by wages share of output and the debt ratio. In the second, we have the wages share of output times the employment rate. And in the third, we have the debt ratio times the wages share of output and itself. So what you've got is semi-quadratics or quadratics in the variables turning up in this system, and that gives you a fundamentally nonlinear set of equations. When nonlinear dynamics in 3 dimensions takes you to a very different world to equilibrium modelling. So it's a model which is, again, sticking with Minsky's argument, because Minsky said it's something you can't reform away. This has got none of the usual bad stuff that we actually use to explain crises like 2008. So it's a pure free market system. There's nothing there that would make an Austrian economist angry. There's no government sector, no Ponzi finance, and importantly, there's no bankruptcy. All contracts have to be honoured, the sort of thing that would make Wolfgang Schäuble a very happy man, so he thinks. So you can't reform those away. And it has 2 main equilibria when you solve it. There's a good equilibrium, which has a positive employment rate, a positive wages share of output, and a finite debt ratio. That's where you'd like to end up. There's actually 3 non-trivial equilibria to the model. The bad equilibrium is 0 employment, 0 wages share of output, and infinite debt. You don't want to go there. Okay? That's effectively like a black hole of debt. Now, what actually happens in the dynamics of the system? Well, there are 2 possible outcomes. You could converge to that good equilibrium, and that's the convergence process for the employment rate. The cycles are very stylised because all the behavioural stuff is linear. You get non-linear, more interesting, realistic-looking cycles when you have non-linear behavioural relations. And I'm just trying to get it as simple as possible, first of all. That's the wages share of output. And here's the debt ratio, which is the additional thing I put into the model that you don't get in mainstream economics. Ratio of private debt to GDP. And that's also cycling towards an equilibrium, in that case the level of 60% of GDP. When you graph the 3 together, you get a nice smooth convergence. Okay? That's what you'd like to have happen. If, on the other hand, you change one of the parameters slightly, and all I'm changing here is how reactive capitalists are to the rate of profit. I'm simply making them more reactive to the rate of profit or have a lower level of the rate of profit, which is the level at which they invest just what they earn. So basically you have more aggressive, more investment-oriented capitalists. What do you think is going to happen to the rate of growth, by the way, if I make the capitalists more inclined to invest? What do you think? Rise or fall? Yeah, think about that later. I'll show you in a moment. So here's what happens, and this is the strange thing about a nonlinear model. What you get is apparent convergence followed by diverging cycles. This is the wages share of output. Same pattern, but notice there's a downward trend in wages share of output. This is the debt ratio. It continues to rise. You go past the equilibrium and then continue cycling on the other side. When you put that together in 3 dimensions, this is what you get. Now, if you're ignoring level of private debt, and this actually matters, then what you're going to see is a smooth convergence to equilibrium. You're going to be taken by surprise when it suddenly starts to break down. And that's the basic nature of complex systems. This particular phenomenon was first discovered in models of fluid flow, back after Lorenz did his model, which was the basis of the way in which meteorology is done these days, nonlinear models of weather interactions. And they found that there was one of the many paths to chaos in this model, the paths from laminar flow, smooth flow of water, to turbulent flow, had a period where it appeared to be diminishing. And this is called a Poincaré map. It's just basically a drawing, but the idea here is putting a slice in 3 dimensions, and you plot where the dynamics goes through this 3-dimensional plane in space. And the dynamics of the process that lead to equilibrium have you bouncing from the line to the curve and back up again. And if you're down the bottom there, that's going to go from turbulent flow to smooth flow. You're going to be in equilibrium. But if there's a slight change in the nature of the curve, so rather than intersecting, it's not quite tangential, you'll have apparently diminishing cycles heading towards laminar flow, and then suddenly you have an explosion into turbulent flow again. And that's what this model, the sort of nature of this model that I'm showing you, actually gives. You can't get it out of an equilibrium model, because this is the model which is general in the sense that it covers dynamics towards equilibrium and away from equilibrium. You've got to analyse whether equilibrium is stable or not. And what you've got is this process that looks like a converging, and then you break down. Now, when I wrote the paper, I did my PhD building this model, and my intention was to model a debt crisis, which is what Minsky spoke about. I had no idea, and there's nothing in Minsky either, to tell you that was likely to be preceded by a period of apparent tranquility. Okay? It's a complete surprise that came out of the mathematics of the model. And I wrote it in August. I actually finished writing the paper in August of '92. Just for the record, I keep a record of the document properties there to show when it was written. So I published in 95, but it took 3 years to turn up in the journal. And when I wrote it in 1992, nobody was talking about a great moderation then, because still the phenomenon that the economists were coping with was stagflation, high rates of inflation and high rates of unemployment. Nobody was talking about a period of tranquility. Now, as economic data went on, we had this transition, but I wrote this before this became part of the literature. So I got the debt crisis, but this unexpected tranquility beforehand was quite a surprise. And I thought it was a nice little way to finish the paper, to finish with a nice little rhetorical statement. That's the dynamics that I built in my model in my PhD, using nonlinear functions that constrain the dynamics more. You still get the same basic shape. That's why I've shown you with a linear model. You don't need the nonlinear functions to get this basic result, but it just gives you a tighter vortex when you pass from stability to instability. So I finished with what I thought was a rhetorical flourish of saying the chaotic dynamics in this paper should warn us against accepting a period of relative tranquility in the capitalist economy as anything other than a lull before the storm. Nice little way to finish a paper, don't you think? Then it goes and bloody well happens. Now, what that implies, that when you look at those two statements between Prescott and Minsky, if you had decreasing volatility in inflation and employment, and the private debt ratio was stabilising, then you'd come down on Prescott's side. Even though he didn't include debt in his thinking, he'd say, okay, well, capitalism's inherently stable then. It's bound for equilibrium. But if you had decreasing volatility in inflation and unemployment before the crisis, and the private debt ratio was rising, then that was not just a sign that Minsky was right, it's also a sign a crisis is approaching. And that's why I started warning about the crisis back in December of 2005, when a number of different reasons why it took that long to get into talking about it. But I'd had a reason to look at the empirical data at that time, and actually being a witness for a court case on predatory lending. And this was my background, knowing that if there's going to be a crisis, it would be driven by a rising level of private debt to GDP, and it would be preceded by a period of apparent moderation. Well, the moderation had already happened. The crisis is what was approaching when I looked at the data. And now we actually are lucky in one sense. We have two data points. Economists like to have lots of data points. They have very, very few compared to physicists. We now have two data points of a crisis. The Great Depression, preceded by the Roaring Twenties, and what we've been through now, preceded by the dot-com bubble and so on. And the data is not brilliant back in the 1920s, but it's still interesting to take a look at it, because if you look at the inflation and employment data for America, you have the same basic pattern, made more complicated by things like return to the gold standard and leaving the gold standard and all sorts of crazy stuff there. But a trend for diminishing cycles in inflation and unemployment before a crisis, when unemployment then explodes and you turn to deflation. And that's what we've had. This is what the Great Moderation was called before the crisis hit. This is American data, of course, from 1980 to 2016. And what you've had is that period of diminishing cycles. That's what Ben Bernanke thought was a great moderation. And then a crisis out of the blue, you go to inflation. Inflation turns to deflation. Unemployment skyrockets. If we use the same numbers, the same way of defining unemployment here, by the way, as was used back here, this would be about 14%. The numbers have been changed quite dramatically in how you define unemployment, unfortunately, over time. Now, both those crises also had the rising debt pattern that I'm talking about, and I'm showing two lines here because the blue line is the rate of change of debt on an annual basis. So you had this increase in debt over time, and then it explodes, and the explosion is driven by deflation. So from 1930 on, prices were falling by up to 10% per annum, which meant GDP was falling faster than debt was falling, because across this whole period, Americans were actually reducing private debt. So the debt level's falling here, but GDP is falling faster, so the ratio rises. So that's the 1920s experience, 1920s, 1940s. This is our most recent data. And you can see the same trend. Rising level of private debt, and then it starts to fall, and the crisis begins when the rate of change of debt starts to slow down, and then of course it gets to be a deep crisis when the rate of change of debt is actually negative. So that's the vision that I had about the crisis. What did mainstream economists see? Well, again, and you'll see this in Bernanke's most recent book, he blames the Great Depression on bad policy by the Federal Reserve. And this is back when he talked at Milton Friedman's birthday party, the 90th birthday party. He's finished by saying, let me end my my talk by abusing my status as a rep of the Federal Reserve. I'd like to say to Milton and Anna Schwartz, regarding the Great Depression, you're right, we did it, but thanks to you, we won't do it again. Well, that didn't last all that long. He interpreted the Great Moderation, and he was one of the ones to provide that term. I don't think he actually originated it, but he certainly promulgated the term. And he said the sources remain controversial, but there's evidence for the view that improved control of inflation has led to this welcome change to the economy. So what he was seeing was a positive development because he wasn't looking in the three dimensions that I've shown you a moment ago. Now, from my point of view, this was just these were phases in exactly the same dynamic process. They're not separate phenomena at all, absolutely tied together. And there are other elements of the model that are intriguing as well. So the system states of the model, the three variables that I showed you earlier, were the employment rate, the debt ratio, and the wages share of output. Now again, all these things were surprises to me coming out of the model. The equilibria were the employment rate, the debt ratio, and the profit share of output. So rather than there be the wages level cycling around or heading towards an equilibrium, it was actually the profit share that cycled around it. Those are the equations there. Again, this is just a linear model, so you can actually do various solutions to them. But the wages share was a residual, and it was negatively related to the level of debt. Now, in the model, it was the capitalists who were doing the borrowing for firms to finance investment. Workers were doing no borrowing at all. But the ones who paid for it were the workers. And that's what you've got as a trend to rising inequality, which we see as well happening in the empirical data too. So it's remarkable how much a very simple model brings out. And these relationships also persist in the dynamic version of the model. That's through showing the equilibrium values. But when I have when I run the model dynamically, if it converges to equilibrium, then you get a stable level of inequality, the stable distribution of income between social classes. But if the model diverges to the bad equilibrium, then you get rising inequality. So inequality is bad not because it's a nasty thing, but because it's a sign of an approaching crisis, which of course we've been through. And how this actually happens is the falling wage share going to workers from who are paid wages by capitalists, of course, is offset by the rising amount they're paying to bankers. So the amount the capitalist is paying sort of fluctuates but remains around a trend until at a certain point the decline in wages can no longer counteract the rising exponential impact of interest on debt, and the system gets overwhelmed, and the capitalists then find out the hard way that things weren't so good after all. So rising inequality is a prelude to a crisis there. Now, that's showing you with a very simple linear model with only three variables and only linear equations, but of course you want to look at it in a more general term where you include price dynamics. So that's relatively simply done, and you'd find there's no particular change to the first equation, but the second one you now have in terms of money wages. So you get money wage, with a wages share of output will rise if money wage demands exceed inflation plus growth in labour productivity, and the debt ratio will rise if the growth in nominal debt exceeds the sum of inflation plus the rate of economic growth. So it's very simple generalisations. But you need additional equations for the rate of inflation, and all I use there is a lag convergence to equilibrium prices, supply and demand, basically, but it actually ends up being identical to what's called Koleski's markup pricing equation from post-Keynesian economics, which is quite intriguing. A variable nominal interest rate, and I have that being set on a lagged inflation premium to the actual base rate of interest. And then with that done, you get a bit more complicated model. That looks a bit scarier, but it's not too. It's still a long way from being as complex as anything in meteorology. And what that's happening there is that there's an inflation-adjusted nominal interest rate, a first-order time lag setting up the inflation affecting the wages share and affecting the debt ratio, and also affecting the premium that banks put on the interest rate above the base rate. So you put that model together, and I'm now going to change to a different way of showing it. This is the same model shown in an open source software package I've designed called Minsky, which you can download if you click on that link there, and I'll give you the presentation later. That will take you to the website where you can download and install the software yourself. And this is something engineers have been using for 30 or 40 years. It was actually first designed in the 50s and late 50s, early 60s by Jay Forrester in management. And there's a whole range of technologies that management consultants and engineers use, things like Stella, I think, VenSim and the management side of the world, and Simulink. Anybody here use MATLAB? Okay. Have you got the Simulink library installed? Right. Okay, you can tell the rest of them about it later. VisSim and a few others. And I designed Minsky because it's very hard to show those, to show banking in those systems, and I'll show you why I've done it after I simulate this particular model. So what I've got here is the same basic process known as a causal model now. So I've got investment over here. Net of depreciation becomes the rate of change of capital stock, which becomes capital, which determines output, which determines employment rate, wages determination, profit, etc., and interest payments over here. And then all the other elements I've shown you beforehand in terms of a markup pricing and an inflation rate are all shown down here. These are flow charts, so I'm taking a bit of a risk to move it because I've got a couple of bugs that have turned up in the software in the last few weeks. But I hope I survived that move. Okay, you move the elements of the model around. You actually design equations using a flowchart. So let's just simulate that model. And this is a richer version of the model I've shown you a moment ago. And what you'll see up here is the employment rate cycling away. Cycles are diminishing. Then cycles start to rise. Inflation here is heading towards, falling from a high level down towards deflation. The debt ratio is rising, as I showed you beforehand. Profit share, as you can see, is fluctuating around an equilibrium level. If you're ignoring debt, nothing bad is happening, except you're going through a few more expanded cycles here. So with a richer model, you get more complicated dynamics. It finally appears to start settling down. You're finally reaching equilibrium. And then without warning, if you're not looking at the debt level, employment plunges. Inflation becomes massive deflation, and the last people to know the system is falling apart are the capitalists. Okay? So that's the sort of dynamics you can get out of a proper nonlinear model of the economy. And it gives you rather different answers to mainstream economics and to a lot of my own background in post-Keynesian economics too. There's the falling wages share I showed you beforehand. Again, even though workers are doing none of the borrowing here, it's offset by a rising share going to bankers. So sitting in the middle are capitalists, and what they see is a smooth process until it all falls apart. And you can't see it if you look just at employment and inflation, because employment before it collapses looks like it's heading down a bit, but it's still stabilising towards the end there. Inflation goes into deflation. As I said, the capitalists are the last ones who can tell what's happening. The real indicator is private debt. That's continuing to rise and finally hits an exponential rate of growth, and that's plotting it against the employment rate and plotting against wages share. So if you leave that variable out of your thinking, you're going to be surprised by what capitalism actually does to you, unfortunately. Now, it's also, I'm going to criticise the Marxian end of the spectrum here as well. A lot of Marxists rabbit on about what they call the tendency for the rate of profit to fall. There is no such tendency. There is a tendency for private debt to grow exponentially, and that's the dangerous one. So I look at the income shares, again, I don't see any trend in profit until the crisis finally comes in at the end there. And the key implications are clearly that you have to worry about the level of private debt. You can't ignore the level of private debt or its rate of change. And too high a level will cause a crisis like the one we've been right just recently. So private debt should be a key target of macroeconomics, as well as inflation and employment. But again, the mainstream rejects it. And this is back quoting Bernanke once more, saying that though he managed to convince Roosevelt about the need for reflation, he didn't convince the academics because of this argument that debt is a pure redistribution. Explaining why that's wrong is one reason I built Minsky. Pardon?
Could you go back?
Yeah, sure. Okay.
Your presentation of Bernanke is a bit misleading.
We can argue over that over a beer. I don't agree.
I don't want to do it over beer. Your implication here is that economists disagree with early inflation. That's what that quotation suggests.
On the role of debt deflation, yeah.
But that's not what Bernanke just said.
What was he saying then?
Well, as I understand it, he was saying in the 1930s, the economists got it wrong. But we today appreciate the strength and insight of early Fisher's idea.
I would love to know how you can see that text there. I'm stunned that your interpretation.
Well, you don't see it there, no. It isn't in that actual passage, but if you read the wider...
No, look, I'm sorry. I'll take you, Hyman Minsky is the person I'm talking about in particular here, and I'll give you the entire 48-word discussion of Hyman Minsky in Bernanke's book. Okay?
I'm not... Okay, hang on. I don't know what Bernanke says about Minsky.
Okay, I'll tell you shortly.
I'm pretty sure that Bernanke was a fan of Irving Fisher and crediting Irving Fisher with deep insight.
Within a neoclassical framework. He reinterpreted him to say that the level of private debt doesn't matter, but he developed a financial accelerator argument out of the fragility arguments he got here. But he still ignores completely Irving Fisher's arguments about level of private debt. Okay?
Your quotation, the quotation you have taken from Bernanke on Fisher is misleading.
I disagree. I left out. I disagree. I've got a further. So I can go off another 2 pages there, but it's all leaving out the role of the level of private debt. He was struggling to say that it wasn't the private debt alone that made the difference. Now, let's go for a more contemporary economist, talking about Paul Krugman shortly. Now, Krugman here rejects the explanation that Richard Koo has given of where the crisis came from in Japan, and he said, and also looking at America as well and England. Criticising Koo, Krugman says, well, Koo talks about an entire economy being balance sheet constrained. He said, that makes no sense. Where there are debtors, there must also be creditors. So there has to be at least some people who can respond to lower real interest rates, even in a balance sheet recession. That's the argument. And that's pretty much the same way that Bernanke talked about it as well. You can't have an entire economy being balance sheet constrained. Stiglitz says the same thing just recently, in a sense, talking about how our banks are back to a reasonable state of health. He's saying, but they're not doing what they should do, which is intermediating between long-term savers and long-term investors. Now, why aren't they lending? Well, let's take a look at the level of debt. This is looking across a number of countries. You can see the USA is the main one that I focus on, but I've got the UK, Euro area there as well, Australia, Japan and China. And we have now got a level of private debt which is unprecedented in the post-war period and in fact unprecedented in the history of capitalism. And what we have in terms of low growth in debt now, and you look at the rate of change of private debt, it's very low because it's got to such a high level that people aren't willing to take on more debt. That's the main reason you're not seeing any lending occurring. It's already too high. And what mainstream economists are trying to encourage is banks to lend to people who don't want to take on more debt, which is rather difficult to do. You notice the Japanese data here. Japan had its crisis back in 1990. Since then, it's mainly been in deleveraging throughout the whole period. Now that we've been through our crisis, all these countries are deleveraging. The exception here is China. Not looking good for China, and I'll explain why in a moment. Now, what you saw with that quote from Krugman was that people banks are just intermediaries. Okay? And if somebody lends to somebody else, then of course one person's spending power goes down, the other person goes up, and they benefit in different ways, so they cancel each other out. And he also argues in his Endless Depression Now that it's not the economy as a whole borrowing more money when debt is rising. He's saying there's no link between change in debt, change in private debt, and the level of money supply. It's just more patient people lending to less patient people. Now, the Bank of England knows a lot better. I'm very happy to be in London these days and be able to interact with the bank as much as I am, because they very bravely came up with this paper in 2014 saying that's quite wrong. It was almost like an open letter to Paul Krugman and a number of other mainstream economists. He's saying when the bank makes a loan, it simultaneously creates the matching deposit, thereby creating new money. So there's a direct link between debt and creation of new money. And again, here's Krugman reacting to that and saying, well, he can't see what's different about that. So I thought I might enlighten him. And what I've done here is show the argument about banks being just intermediaries, just in terms of a double entry bookkeeping table. So if you imagine the banking system having reserves and a person who's a saver, or a group that are savers and a group that are investors, then when savers lend to investors and they're not banks, there's just a shuffling around of the liabilities on the liabilities of the banking system. Equally, when debts are repaid, and all you're doing is changing where the liabilities are. You're not changing how many liabilities there are. Nothing is happening on the asset side. But if you see banks as creators of money by lending, then when they create a loan, there's an increase in the assets matched by an increase in the liabilities. When the loan's repaid, there's a fall in the liabilities matched by a fall in the assets. So it's quite a different thing to say that the banks are doing the lending rather than the non-banks. But Krugman argues there's no difference still. Well, let's take a look. What I've done here is model this in Minsky, and I'm just again hoping that font bug doesn't get in the way here. Let's see. So what Minsky lets me do, as well as doing the flowchart stuff I showed you earlier, is designed to use double entry bookkeeping to keep track of financial flows, which when you try to do these financial flows with the flowchart, it just gets like you're throwing a whole lot of spaghetti on a table. It's just impossible to differentiate, because to do financial transactions properly, you have to record every transaction 4 times. Once in the account, from the person from to the person to, and then if they have different banks, there's a exchange of reserves as well between the banks. So it gets quite complicated. What I've done here is model the neoclassical or the loanable funds vision of lending as being between one agent who's the consumer sector and another agent who's the investing sector. And then if I simulate, and then of course they pay interest to each other and debts gets expanded and repaid. And I can change the rate at which lending and repayment occurs by changing these parameters over here. So if I simulate this model, notice the growth rate is 0. Debt ratio is still rising. GDP here is flatlining at about 200. Now if I increase the rate of lending, the growth rate dips a bit. If I slow down repayment so debt lasts longer, debt rises. Again, the growth rate drops a bit. You can see the debt ratio rising away there. Finally, the level of debt exceeds the level of money in the economy. Now, if I then have but notice there's not much happening in GDP or growth. Now, if I have a dramatic increase in how fast people repay debt, GDP growth actually accelerates for a while, and a slowdown in how fast lending occurs, then I'm getting a big change in the debt to GDP ratio. Very little change to GDP. It just changes because of those redistributions to people with different marginal propensities to spend. So pretty much you can ignore the level of private debt there. Now, given that doing these things live can be a problem, I'll go to another model where I've made that change immediately. And all I've done in this model, pardon me, did I bring it up? Okay. All I've done here is just shuffle around the loan to make the loan the asset of the bank rather than the asset of the consumer sector. That's the only change. Now if I simulate this model, for a start I get a positive growth rate. You might notice that GDP is growing because the change in money is adding to demand in the economy and the money supply as well. If lending accelerates, the growth rate jumps. If repayment slows down, it grows even more. And if people then repay more rapidly or lending occurs more slowly, you get a downturn in GDP. So it makes a huge difference to take into account the way that banks function in the economy. And that's what's being left out of the mainstream version that still treats banks as though they're intermediaries rather than loan originators. So loanable funds, banks just intermediate between savers and investors. There's no creation of money by lending, no creation of additional demand either. Whereas what I'm showing you, which is the real world, which we call endogenous money, and the Bank of England is now using the same term, banks originate loans. Money is created by the lending, and that also creates additional demand. And equally, when that money is repaid, if it's repaid en masse more than it's being extended, you have a destruction in demand. So change in debt is adding to demand. This comes back to Minsky's statement I showed you earlier. But that gives you a dilemma. How do you reconcile that with the identity that expenditure is identically equal to income? Okay? And this is something which has led to a bit of a fight in post-Keynesian economics. It still isn't over. I think I've won it, but I still have to get to convince the other people on the other side of that debate. And I was challenged in saying, well, you've got to be making a mistake to say change in debt turns up in demand because expenditure is identical to income. How can you have change in debt turning up there? And I realised that they were right. If I couldn't show it using the argument that expenditure is identical to income, then I hadn't proved my case. So I was trying all sorts of tricks about timing sequences and Lebesgue integrations and so on, and I didn't convince anybody. What I've done here is say, well, let's just take a model of the economy with just 3 sectors. It doesn't matter what they are, I'm just labelling S1, S2, S3. I'm going to label expenditure which is not financed out of debt with capital letters and expenditure financed out of debt with lowercase letters. And then I'll look at 3 situations. One where no borrowing can occur at all. One where you can borrow from other sectors, which is the loanable funds argument. And the other where borrowing from banks is possible, if that's endogenous money. And the first case is actually, well, you might call it Say's law, but it's actually Say's law in reverse. Demand creates its own supply. So what I've got is expenditure being shown horizontally and income vertically. And every row necessarily sums to 0 because this is expenditure by sector 1 on sector 2 and sector 3. And ditto sector 2 on the other 2 sectors and so on. So the rows necessarily sum to 0. The columns can be non-zero. The total sum is 0. And the diagonal, the negative of the diagonal is aggregate expenditure, and the off-diagonal elements are aggregate income. So you can see the identity is going to be maintained no matter what I feed into this argument. Now you do it for that particular case where there's no borrowing, and of course expenditure is identically equal to income. This is using symbolic logic programs to add up the variables now. With loanable funds, you have Sector 1 borrowing from Sector 2 and spending on Sector 3. I'm just doing the simplest possible arrangement so I don't get lots of complicated terms, but it generalises completely. So Sector 1's funds for spending increase by B, Sector 2's funds fall by B. So you look at the math and you're going to find overall they cancel out, and you get the same basic argument that the only way you can get a change here is that there's a change in the marginal spending propensities. But what if a bank lends to Sector 1? Well, the assets of the banking sector are going to rise and the liabilities at the same time. And the increase in spending power for Sector 1 is not offset by any fall in spending power for the other two sectors. So what I'm showing now is lending creates a loan on the bank asset side, adds to the spending power of Sector 1, which then spends on Sector 3. And when you add up, you get your aggregate demand and your aggregate expenditure both include the change in debt. So that's the way that it fits into the system, and that's why it's so important, because that's the most volatile part of expenditure, is that change in debt. Credit is the most volatile part of our spending. So you get an increase in income and expenditure, and that reconciles that identity in a way that sort of turns me into a proto-monetarist, which rather amuses some of my friends. Expenditure is the sum of expenditure financed by the turnover of existing money, so the idea of velocity of money matters. Now you can measure that, however poorly you measure it, as GDP. Okay? Imagine a river. Okay? How do you measure the rate of flow of a river? It's fairly simple. You work out the cross-sectional area at a particular point and then work out the velocity passing that point. You can therefore work out the flow per second, per year, whatever way you want to measure it. GDP itself is like that. And that's dimensioned in dollars per year. Plus you have expenditure financed by new debt. Now, it's like having a pump, pumping water into or sucking water out of the river at that point. That's measured rather more accurately as change in debt, and that's also dimensioned in dollars per year. And then you also have gross financial transactions turning up, which I haven't bothered covering here. It's just a bit too complicated for a short talk. So total expenditure is therefore equal to aggregate, the turnover of existing money, plus the change in debt, plus gross financial transactions. And the income side, of course, the vast majority of money that's borrowed these days isn't to buy goods and services or invest in factories, it's to speculate on the value of housing. So you've got to include net asset transactions as well, capital gains. So I see the overall relationship being GDP plus realised capital gains being equal to the turnover of existing money plus new debt plus gross financial transactions. And what you therefore get when you take a look at the second differential, the first differential of that, you get a term in the acceleration of debt. And what you therefore get, the acceleration of debt, is a major determinant of the change in economic activity. And that's why it's so volatile, what's so hard to pick up changes in direction, because you're looking at the change in the change of another variable. So the change in debt and economic activity are strongly related, as are the acceleration of debt and change in economic activity, and also again in asset markets. And these are all findings which contradict, I think, not just mainstream, it's also a lot of non-mainstream thinkers, because they still haven't properly integrated the role of credit in the system. What you find is that rather than being a pure redistribution with no significant macroeconomic impact, which is that's a direct quote, they're the main determinants of macroeconomic outcomes. And rather than leverage not mattering, which again is mainstream finance theory, leverage is the main thing that determines asset prices. So to give you some empirical data on that, this is looking at the relationship in America from 1980 between change in debt and the level of unemployment. Correlation minus 0.64. When you take the 1990 on, the correlation is minus 0.93. Now that looks like a fairly significant macroeconomic impact to me. Then you look at the acceleration in debt and change in employment. Correlation there is minus 0.8. Again, they're pretty. For something that's not significant, that's a pretty big number. Asset markets. This is looking at change in mortgage debt versus house price changes. And again, the correlation there is extremely strong. What's driving it is actually this change in credit. And so now looking at the S&P, even with margin debt, which has got less reason to be dominant than mortgage debt has, the same type of strong correlation turns up. rather than leverage not mattering at all. Leverage is actually essential. And this is now looking at China. This is a remarkable chart. This is China's the Shanghai index on the left-hand side. The right-hand side is the level of margin debt compared to GDP. They've already had one big bubble and crash back in 2008 when there was no debt whatsoever in the, well, there would have been some debt probably, but not margin debt in the stock market. Now, they've gone from 0 in 2010 to 2.2% of GDP in the middle of last year. And then if I look at the what's happening with margin debt in China right now, again, the same correlations I'm showing you for America are turning up in the Chinese data as well. So one reason I argue China's in for a lovely crisis. So what Minsky gives you is an approach, explanations that things the mainstream can't capture, but it uses an approach that the mainstream explicitly rejects. Because when you look at how Minsky's work is done, the approach that I take to Minsky as well, you can see it directly is juxtaposed to what the mainstream says is the way you should build models. So if you look at the Lucas critique, the argument is you must actually look at what individuals do, methodological individualism. This is quoting from a lecture that Krugman gave back in the 90s to a bunch of evolutionary biologists and saying economics is about what individuals do. Okay? You've got to start from methodological individualism. What I'm doing is starting structurally, working from the top down, which has got a lot more to do with Karl Marx than it has with Paul Krugman. Maximisation and equilibrium is the approach. I'm saying you've got to work in complex systems dynamics. You've got to look at the interactions of a system in general rather than just restricting yourself to equilibrium roles. Money plays no essential role in the mainstream. There's certainly no role for debt in the mainstream modelling. The modelling I'm doing is fundamentally monetary. And one didn't see the crisis coming and the other expected it and saw it coming. So I think that the complex systems approach is the approach we should be adopting to do economics in future.
Sorry. This is just preposterous. It's absolutely preposterous to say that Krugman thinks money plays no role. I mean, that's just ridiculous. Absolutely absurd.
You've spoken with him, have you?
Sorry?
You've spoken with him, have you? I have. Okay. You're telling me that he hasn't told me what he's told me.
I'm sorry, I don't eat. That gives you one understood.
Is there internet linking here? Is there a password?
You don't need to do this. You can carry on.
Okay. Search for Paul Krugman and Steve Keen on the internet and see what you find. That is not a caricature of him at all. So from the point of view I'm putting forward to you, capitalism is inherently unstable. What we've been through is it's not something which is due to bad regulation or bad behaviour. The Big Short's important, but it doesn't explain why the crisis actually happened. We could still have crises without that sort of behaviour. And you need fiat money as well as credit money to avoid these sorts of crises. While the government trying to run surpluses all the time, it's actually not been contributing the money that it could contribute to stabilise what a pure market system does alone. And rather than having secular stagnation occurring right now, we've got stagnant credit. That's really the major reason why growth is so low. So I believe we have to reduce the level of private debt to get out of this crisis. And I'm arguing for what's called the people's QE. I call it a modern debt jubilee. If you look at how QE is being practiced right now, it's buying assets from pension funds and insurance funds who, of course, then buy other assets. So it's helping inflate the asset side of the financial system when it's already excessively inflated by leverage. And you get a small spillover into the rest of the economy, which is where part of the recovery has come from. But what you could do with people's QE is use the government's capacity to create money to inject funds directly into bank accounts on the condition that people in debt have to pay their debt down. So rather than benefiting debtors alone by an old-fashioned jubilee, you benefit everybody, but debtors must reduce their debt while savers would get a cash injection. And you could then reduce debt and asset prices, making housing more affordable for most of the audience here, without reducing demand in the process. And you could motivate banks to lend again because they'd have lots of non-income earning assets and less income earning assets and more reason to want to lend, and there'd be less debt to stop people doing the borrowing in the first place. So in terms of our objectives as economists, one of them we should have is to get that debt level, the private debt, down below 100% of GDP, well below, preferably. and also to redesign lending so we don't have Ponzi schemes being generated all the time by banks with rising mortgage debt driving asset prices and causing bubbles that then burst. So one idea I have there is I call it the pill, which used to be a fairly fashionable term. It's got less relevance these days. But property income limited leverage, rather than limiting lending supposedly on the basis of the borrower's income and collateral, put some maximum amount of lending which can be done relative to an asset's income earning capacity. So if you're buying a house which rents for, say, £10,000 a year, the maximum you could borrow would be 10 times that, £100,000 a year. And it cuts out that feedback effect between rising asset prices and rising leverage. I'd ban margin lending completely. It's like having a credit card inside a casino. And I'd rather encourage what I call Schumpeterian lending, where you lend to entrepreneurs, because one thing the banking sector doesn't do, which it should do, is provide finance for people with good ideas and no money. It's almost impossible to get entrepreneurial funding from the banking sector. You can get it from venture capitalists, but I'd like to see banks being melded with venture capitalists, being able to take an equity position when they make a loan in an entrepreneur. Now, likelihood of those reforms? Pretty much that, I reckon. Pigs might fly. But the longer we go through this crisis, I think the more likely we're going to see it happen, because if we don't do something that brings this level of debt down, we're going to recreate Japan's experience of the last quarter of a century now. They call it a lost decade. It's actually a lost quarter century, without the potential to run a trade surplus, because we can't all do that, and without their stimulatory fiscal policy because of the paranoia that mainstream politicians have about the level of government debt. So what I've done here in this chart is to say, what could that world look like if we just replicate what Japan has done? I've taken Japan's private debt data now and moved it forward so its crisis coincides with the crisis we actually had. And that could be the general trajectory we expect for private debt in the future. What does that mean in terms of credit growth? Well, it means negative credit growth for most of the future. So rather than credit adding to demand, which is a legitimate thing for credit to do, I'm not arguing against that. I'm arguing about having to monitor how much it happens. But if we have deleveraging all the way through, then aggregate demand is going to be lower than it could be otherwise. Growth will be lower, unemployment higher, etc., etc. We'll be stuck in that stagnation state that Japan has found itself in for 1/4 of a century now. Now, in terms of what I think is going to happen pretty shortly, this is now looking at the level of private debt in Japan, China and America from the beginning of their bubbles. China's bubble really began in 2009. Its response to the financial crisis, which drastically reduced its exports, was to start a credit bubble. And that's caused an enormous amount of construction in China. America began back in 1993. That's when they started borrowing money again after the 1992 recession. And Japan from 1980. Now, looking at that, you can see the rate of growth of debt in China is far faster than either America or Japan. So when it slows down, and it's starting to do that now, it'll have a more dramatic impact upon those economies than actually happened in America and Japan, because it's something like about 1/4 of China's GDP in terms of effective level of demand will disappear from the global economy. And that appears to be happening now in what we're seeing in terms of trade figures and rather lacklustre export performance from the rest of the world. So that's the sort of world we're getting ourselves trapped in. And just to finish on a few notes about the British economy, I know somehow the Labor Party managed to let the Conservatives sell the argument that rampant government spending caused the crisis. You don't cause a crisis by things that happen after the crisis begins. That's the level of private debt, the red line, far higher than the level of public debt. The GFC mark is August in 2007, which is when the crisis began globally. It began particularly in America, of course, and the rate of growth of private government debt only increases on the other side of that crisis. It's this rise that actually gave cause to the crisis. And this is looking now at the rate of change in private debt and the rate of change in public debt. Again, you had an enormous bubble driven by rising credit in the private sector. The government was therefore able to look like it was doing responsible management, occasionally running a surplus. But then when the private sector borrowing stopped and the economy slumps, the government spending had to rise. So the government was effectively, it's like blaming the air conditioning system for an overheated room. Okay? The government is responding as an air conditioning system does to excessive heat by trying to cool the system down. So that's the reason government spending has risen, not because it caused the crisis, it reacted to the crisis. Now, obviously on this point I think there's an enormous need to redo economic pedagogy in general. and read the originals too. I want to teach neoclassical economics well, but with warts and all. You get a very airbrushed version in most courses about what neoclassical economics is like and what its flaws are. And I do see it as a passing phase in the history of economic thought. I don't think it should continue. We also need to learn from other schools of thought, and none of them have got a complete alternative. That includes the post-Keynesian school that I come from. This is just a partial list of the number of different schools of thought that are out there. By the way, there was a fascinating argument televised live between a couple of students in Denmark and one of their professors about whether there should be reform in economics. Quite fascinating thing. Do look it up on YouTube. There's a translation of the dialogue, of course. And in it, their professor said that there were, he mentioned there's the vast majority neoclassical and like 99% are neoclassical, and there's 1% that are all these other little schools. Funnily enough, we actually have some empirical measure of what the scale is of people who believe neoclassical economics versus those who are critics coming out of France, because France is a very top-down system. You've got to be registered at the bureaucratic level in France to be an academic economist. We know exactly how many there are, 1,800 roughly. And the post-Keynesian group there put out a call to have a heterodox wing, a new formal structure, so that they could get promotions inside that formal structure, etc., etc. The government agreed to it and then rejected it with the incursion of the most recent Nobel Prize winner being a major factor into why they backtracked from doing it. But when that was done, 300 of the academics asked to move across. So roughly 1 in 6 belong to these alternative schools. You should also learn complex systems approaches to modelling in general. There's a huge amount we've learned in other sciences and real sciences that hasn't made its way into economics because of this fetish for equilibrium modelling in economics, and learn thermodynamics as well. Now, these are two places I thought you wouldn't get taught that, so I'll leave that there, but you would get it from me at Kingston. Thank you.